Farm business analysis. The content we are going to discuss now are farm business analysis, farm efficiency measures, physical efficiency measures, land use efficiency, labor efficiency measures, machinery efficiency, financial efficiency measures, aggregate measures, ratio measure, measures of farm income and profit efficiency, farm costing. Introduction. Farm business analysis. It is a technique based on computation and interpretation of a variety of efficiency measures. It is done for the farm under the study. The results are then compared with standards derived comparison to highlight the organizational weakness and strengths of the farm business. Farm efficiency measures. It is an important element in a farm business. Management or decision making relates to how available resources are allocated. A measuring stick. A measuring stick is to provide guides and standard for appraising accuracy of decisions. Efficient method of production yields a greater valuable output per unit of a valuable input. Physical efficiency measures, aggregate measures, total area of the farm, number of livestock, total population. Ratio measures, land use efficiency. It indices measuring the rate of production or, and there are three factors. First one is yield per acre, production efficiency in terms of percentage as compared with the average yield of locality. Example, wheat yield per acre of farm is 30 quintals, average yield of locality 10 quintals, production efficiency of farm equal to 13 into 10. Next, crop yield index, measure of comparison of the yield of all crops on a given farm with the average yield of these crops in locality, expressed in terms of percentage, combines all the yield into a single figure. Next, intensity of cropping. It measures the extent of the use of land for cropping purpose during a given year. It is expressed as percentage. Cropping intensity equal to area cropped by total cultivated area into 100. Next, percentage of land under selected crops. Labor efficiency measures. To know whether the labor on a farm is more or less than what is required. Crop acreage per man equivalent, computed by dividing the total acres in crops by man equivalents. Productive man work units per man equivalent. Productive man work units per man equal to total productive man work equivalents divided by man equivalent. Machinery efficiency, horsepower per acre of land available and used. Financial efficiency measures, aggregate measure, total capital managed, gross income, gross expenses, gross profit, net worth equal to total assets minus total liabilities. Ratio measures, gross output by gross input, fertilizer cost per crop acre, power and equipment cost per crop acre equal to total cost of machinery divided by total crop acres. Power and equipment divided by investment per acre equal to total machinery investment divided by total crop acres. Cost ratios. Operating cost ratio equal to operating expenses divided by gross profit. Fixed gross ratio equal to fixed expenses by gross profit. Gross cost ratio equal to total expenses by gross income. Cost per acre equal to total expenses by number of acres. Capital ratios. Capital per unit of gross profit equal to total capital investment by gross income. Income ratios. Rate of capital turnover equal to gross income by total farm assets into 100. Net income per acre equal to gross income minus gross expenses by number of acres. Financial solvency ratios. Net capital ratio, working ratio, current ratio. Farm costing. Cost to money value of effort expended or sacrifice made in producing an article or rendering a service or achieving a specific purpose. Role of cost in farm management. Choosing from among varied alternative course of action, pricing decision, determining optimum level of operation, deciding replacement of a capital investment by a new one, deciding whether to sell a produce at one stage of processing or to further process it, cost data are needed, decide whether an equipment is to be bought or hired, cost data are essential, vital role in performance evaluation and returns analysis. Opportunity cost versus actual cost. Opportunity cost. Cost that refers the value of benefits of a foregone alternative. Income from the missed alternative. It would arise only when there are alternatives. In resource allocation problems. Out of pocket versus imputed cost. cost that involves an actual outlay of a cash immediately or in a near future. Material cost, labor cost, and interest on borrowed funds are examples. Imputed cost does not involve actual outlay. It refers to assumed cost or hypothetical cost. It includes the assumed cost of using owned resource for the business. Thank you.